Now we are going to discuss the other ratios. Number one is current ratio. Current ratio is current assets upon current liabilities. Now what we include in current assets? Cash, bank, BR, bill receivable, debtors, sundry debtors, closing stock, marketable securities, cash, bank, bill receivable, sundry debtors, closing stock, marketable securities, and last is prepaid expenses. What are marketable securities? Which can easily be sold in the market. Normally it is for 90 days and we can sell them in the market easily. So they are called current assets. Then what are current liabilities? Bills payable, sundry creditors, outstanding expenses, short-term loans. So we include bills payable, sundry creditors, outstanding expenses, short-term loans. So they are called current liabilities. So current assets upon current liabilities. Normal ratio is, or ideal ratio is, two is to 1. That and business normally must have current assets twice of current liabilities. Number 2, we are going to take liquid ratio. Or this is also called quick ratio. Q-I-C-K, quick ratio. Now liquid assets upon current liabilities. Liquid assets in liquid assets is equal to all current assets except closing stock, and prepaid expenses. But we include in liquid assets all current assets except closing stock and prepaid expenses. Liquid current liabilities are the same. So this is liquid assets. This ideal is 1:1. That liquid assets must be equal to current liabilities. Then the third is debt equity ratio. Is equal to debt upon equity. Debt is what we call debt. Long-term loans and debentures. To debt we call long-term loans and debentures. And in equity share capital plus general reserve plus credit balance of P&L. Equity share capital plus general reserve plus credit balance of P&L. So they are plus equity share premium. Equity share premium. We include equity share capital plus general reserve plus credit balance of P&L plus equity share premium. That we include in equity. Then fourth, total assets to debt. Debt ratio. Actually, this ratio shows that what is the ratio relationship between debt and equity, our own funds and debt. How many times our own funds are more than times half of debt. Total assets to debt. So debt upon total assets. What is this? Debt upon total assets. Debt I have already told you, long-term loans and debentures. Total assets you can take from the asset side of the balance sheet. Then fifth is operating ratio. This is cost of goods sold plus operating expenses upon net sales This is what cost of goods sold plus other operating expenses upon net sales. So this is called operating ratio, that how our business is operating, is doing. How much is our out of net sales, how much we are having operating cost. That is cost of goods sold plus other operating expenses. Then sixth, we are having proprietary ratio. Is equal to proprietors funds upon total assets. What are proprietors funds? Shareholders funds, or we call this also shareholders funds. Here we include equity capital, plus preference capital, plus credit balance general reserve, plus credit balance of P&L. Less fictitious assets. Fictitious assets are for the namesake only, like debit balance of P&L or miscellaneous expenditure on the asset side. Then seventh is working capital turnover ratio. Working capital turnover ratio. So here we use cost of goods sold upon working capital. Cost of goods sold, you can work out opening stock plus net purchases plus direct expenses minus closing stock. Or we can working capital. What is working capital? Is equal to total of current assets minus total of current liabilities. What is working capital? Current assets minus current, total of current assets minus total of current liabilities. And the last one is return on investment or return on capital employed. Here it is net profit before interest, tax and dividend.